Imagine this. A company that's literally designed to reach for the stars suddenly seems to hit, well, a massive financial black hole. That's really the story we're digging into today with Redwire Corporation. They're a space infrastructure company. And bam, their stock just plummeted over 30%. So you might be sitting there wondering, is this, a rare buying opportunity? Maybe a launchpad back to recovery? Or is it actually a classic value trap just waiting to snag investors? Our mission here in this deep dive is pretty clear. We want to pull out the most important insights from, well, all the available sources on Redwire, everything from that recent earnings shock to their really bold long-term vision. We'll help you understand exactly what happened, what it really means, and maybe what the future could hold for them. And hey, for those of you keeping a close eye on Redwire, definitely stay tuned. We're going to be covering their earnings within minutes of release right here. Okay, so to give you a clear roadmap, we've split this deep dive into two main parts. Simple enough. In part one, we'll lay the groundwork.
We'll look at the company's core business, we'll evaluate the management team, and really dissect their financial health. Numbers time. Then, in part two, we'll kind of zoom out. We'll look at the broader market sentiment, dig into their pretty unique ownership structure, analyze the risks involved, and finally, try to draw some conclusions.
All right, let's jump right in then. We're starting with Chapter 1, Business Understanding. So, at its heart, what exactly does Redwire Corporation do in this vast space economy?
Well, Redwire operates on what people often call the picks and shovels model for the space industry. Think of them not as the ones digging for gold, but the essential suppliers. They're selling the shovels, the picks, the maps, They don't launch the rockets themselves. Instead, they provide the critical infrastructure, those vital components and specialized services that really enable almost every space mission. Could be a satellite, could be a lunar lander, deep space probe. They're involved. And their main customers, they're the big players. Government agencies, think NASA, Department of Defense, and also those major commercial aerospace contractors.
Okay, picks and shovels, got it. And how do they actually make money from providing these essential services? What's the revenue model?
Their revenue comes from a mix, really. Different contract types. Fixed price, cost plus, and time and material. Now, what's really crucial to understand about that recent Q2 2025 earnings, the one that just hammered the stock, is how it connects directly to those fixed price and developmental contracts. The company reported these massive cost overruns. They used the term unfavorable EAC changes.
So to simplify, imagine they bid on a project, right? They estimate it will cost X dollars. Unfavorable EAC changes basically means their actual costs they ballooned way beyond X. What should have been a profitable project turned into a pretty significant financial drain. They essentially misjudged the cost or the timeline pretty badly, leading to a huge write-down.
Okay, that makes the Q2 disaster much clearer. So beyond just providing these fundamental services, what specific tools are they actually making? What are some key product lines?
Absolutely. Yeah, their portfolio is incredibly diverse. It covers really critical building blocks for, modern space missions. For example, in avionics and sensors, they provide these super high reliability components, stuff that's essential for big programs like NASA's Artemis lunar missions. Then there's power generation. They're actually pretty famous for their patented rollout solar array technology, ROS, they call it.
Oh yeah, RSA. I've heard of that.
Right. It's currently generating power right now on the International Space Station, and it's planned for the Lunar Gateway as well.
Wow.
They also do structures and mechanisms, things like deployable structures, advanced docking systems like the IBDM. That's really crucial for building things in space. And on the really innovative front, in microgravity payloads, they developed the additive manufacturing facility. It's basically a 3D printer up on the ISS. They're even pushing into new areas like exploring pharmaceutical development in microgravity. That's their new venture called SpaceMD.
So they're not just like bolting parts together.
Yeah.
They're really embedded in the future of how we operate in space.
Precisely. And Redwire itself, was formed back in 2020 by consolidating a bunch of smaller, already established firms. This unique origin gives them something incredibly valuable: decades of flight heritage. That's a critical term in this industry. It means their components are proven, they work reliably in the extreme conditions of space, they've flown on over 200 successful missions.
And without that
verified track record, yes, space agencies just won't trust you, not with their multi-billion-dollar rockets and satellites. So this positions them as a critical Tier 1 or Tier 2 supplier. They operate with this strategy, heritage plus innovation.
That deep experience, that heritage, it sounds like a massive advantage. So what does this all mean for the broader market they're in? What are the key trends shaping Redwire's opportunities?
Well, what's really fascinating and a huge tailwind for them is the global space economy itself. It's just exploding. Projections show it nearly tripling from about $613 billion in 2024 to maybe $1.8 trillion by 2035. It's huge growth. And Redwire's capabilities, they align perfectly with the key trends driving this boom. Think about satellite mega constellations, SpaceX's Starlink, Amazon's Kuiper, they need parts. Then there's the whole growing field of in-space servicing, assembly, and manufacturing ISAM. Redwire is actually seen as a leader there. And of course, the expanding defense and national security market. That's a segment they've really leaned into recently with that Edge Autonomy acquisition.
Okay, sounds like they're definitely positioned in a growing field, but no company exists in a bubble.
Mm-hmm.
What's the competitive landscape look like? And what are the downsides of this picks and shovels model?
Right, the competition is quite diverse. You've got the enormous defense primes, Northrop Grumman, RTX, the giants, and then more specialized providers too. And here's that double-edged sword of the picks and shovels strategy you mentioned. Yes, it makes them a vital supplier, absolutely. But it also exposes them to the concentrated buying power of just a few large prime customers. Combine that with the often unpredictable nature of government contracting, well, it can lead to significant execution risk, which again loops right back to that Q2 earnings disaster we talked about. They're dependent on these larger entities' programs, and those programs can face budget delays, shifting priorities, even cancellations. It's tough. Plus, the regulatory environment is incredibly complex. FAA, FCC, strict export controls like ITAR. It's a maze. But that complexity also creates pretty substantial barriers to entry, especially that need for flight heritage we keep mentioning. It's hard for newcomers. So Redwire's competitive advantages really come from their strong brand, that reputation built on 200-plus successful missions. There are also high switching costs once they get a design win. Think of it like this. If one of Redwire's specialized sensors gets designed into a new satellite,
It's really hard to swap it out later.
exactly. It's incredibly hard and costly for the customer to switch suppliers midstream. It basically locks Redwire in for that program. They also have a unique asset and IP portfolio, over 100 patents, especially in areas like in-space 3D printing. However, and this is a big however, cost advantages are definitely not their strength. We see that in their consistently poor margins and the ongoing challenges they seem to have integrating all those acquisitions they made.
Okay, let's pivot then. Let's move on to Chapter 2, Management Evaluation. You've laid out the business, the market, the challenges. Now, who's actually steering the ship at Redwire?
Well, the CEO is Peter Canuto. He brings a solid background in defense and tech. He was even nominated for Satellite Executive of the Year in 2025, which is, quite an honor, but there's just no getting around it. The Q2 2025 earnings report was the biggest crisis of his tenure so far. The market reaction was, frankly, brutal, and it put his leadership squarely under the microscope.
Right. So how did management handle this?
Yeah.
That earnings call must have been intense. Did they provide clarity, or was it more damage control?
During the earnings call, management tried to frame these really catastrophic results as just a transitional issue. They reiterated the picks and shovels strategy. They highlighted future positives like those lunar gateway tests, the Edge Autonomy acquisition. But there was this significant disconnect. You could really feel it. A disconnect between what management wanted to talk about and what investors were desperate to understand. Management focused on external factors, future business, but investors were deeply concerned about the current operational failures. Specifically, that $25.2 million unfavorable EAC adjustment.
That cost overrun number.
Exactly. That's the core issue, right? Their apparent inability to accurately estimate and control project costs. And maybe the most damaging decision they made was to completely withdraw their adjusted EBITDA guidance.
Oof, that signals uncertainty.
A profound lack of visibility into their own operations. It just completely eroded investor confidence. The market's verdict was swift, clear. That 30% stock collapse tells the story. And while they generally stick to standard disclosures, pulling guidance like that was a huge step backward for transparency. It's also worth mentioning there is a pending securities lawsuit, Lemon v. Redwire Corp. They even recorded a $7.0 million loss contingency for it. That's potentially another red flag hinting at deeper issues.
A very tough earnings call indeed. Okay, let's shift to the numbers now. Chapter 3, Financial Analysis. Management strategy, communication, that's one piece. But the financials really tell the tale of a company's health. What do Redwire's numbers reveal?
Well, after that big drop, Redwire's market cap is sitting around $730 million. Now, looking at revenue, it's a tale of two cities almost. They had phenomenal growth, 88.5% annualized over the last 5 years, reaching $304 million in fiscal 2024. Really impressive. But that growth just slammed to a halt in Q2 2025, a 20.9% year-over-year decline, down to just $61.8 million. That sudden reversal, that jarring halt in growth, was definitely a primary driver of that huge negative market reaction. Now, when we look at profitability, well, this has consistently been Redwire's Achilles heel. Their gross margin, looking at the trailing 12 months, is just razor-thin, 2.53%.
Wow, 2.5%.
Yeah, it indicates almost no pricing power, brutal competition, likely. Then the operating margin, how much profit from core operations before interest and taxes, deeply negative, minus 41.49% over the last 12 months. And it plunged to an alarming minus 149% in Q2 2025 alone because of those massive EAC write-downs.
Minus 149%. So for every dollar they brought in.
They lost $1.49 just running the business that quarter. It's staggering. The net profit margin, the bottom line, minus 71.95% over the last 12 months, just for context.
Yeah.
They lost $155 million net in 2024, and then an unprecedented $97 million net loss in just Q2 2025. So the sea of red ink isn't just showing they're unprofitable, it's showing their core operations are fundamentally destroying value at a really alarming rate right now.
That is a stark picture. What about cash flow? Are they just burning through cash, or can they sustain themselves?
Their free cash flow generation has been consistently negative. They burn more cash than they bring in from operations, and this accelerated dramatically. Minus $93.5 million in Q2 2025 alone. That's an 8-fold increase in cash burn year over year.
8 times worse.
Yeah. It highlights a really severe deterioration in their cash management. In terms of financial stability, well, their earnings are consistent only in being negative. They've never been profitable as a public company, and the losses seem to be getting bigger. Debt levels are definitely a significant concern for a company bleeding cash like this, with negative operational earnings and free cash flow. Now, that recent equity offering was used to pay down some debt, but it came at that steep cost of dilution we'll talk more about. On maybe one slightly brighter note, their current ratio, which measures short-term liquidity, is 1.46. That indicates they probably have adequate assets to cover their immediate bills, for now.
Okay, given all these really challenging numbers, how do we even start to think about valuing this company?
All right, well, the traditional price-to-earnings, PE ratio, it's meaningless here. Negative earnings, you can't calculate it. So a more useful metric, maybe, is the price-to-sales, or PS ratio. That's currently around 4.86 times. Now, how does that compare? It's significantly higher than large, stable defense primes like Northrop Grumman, which trades around 2.1x sales, but it's dramatically lower than other high-growth but still unprofitable space companies like Rocket Lab. Rocket Lab has traded as high as 45 times sales.
Huge difference.
Massive difference. It shows a really severe compression of Redwire's valuation multiple after these Q2 failures. The market is pricing in a lot of risk. Now, discounted cash flow, or DCF analysis, is a way to estimate intrinsic value by projecting future cash flows and discounting them back. An educational DCF model for Redwire, I have to stress, is subject to an exceptionally high degree of uncertainty, especially given those Q2 results. It's very speculative right now. However, running the numbers, our model estimates an intrinsic value range somewhere between $7.50 and $14 per share.
That's a really wide range.
It is, and that wide range reflects the highly binary nature of this investment. It's either a potential turnaround story or, well, a trap. The model has to make some pretty aggressive speculative assumptions, like very high future revenue growth, assuming that edge autonomy deal really pays off, and eventually shifting to stable profitability, which, based on their history, is unproven right now.
Okay, let's shift gears. We're moving into part 2 now, starting with chapter 4, market sentiment. We've dissected the business, management, financials. How is the broader market actually reacting to all this?
Well, what's really striking here is this display of almost conflicting views on Wall Street. It's fascinating. Despite that massive stock collapse, the consensus analyst rating, still a buy, and the average 12-month price targets are remarkably high, somewhere between $19.29 and $22.25.
Wait, that implies over 100% upside from where it is now, around $9.47.
Exactly. Over 100% upside implied by the average analyst target, even after the crash. It's almost like analysts are looking at one picture and the market itself is voting instantaneously on a completely different one. The market acts like that voting machine, right? Reprices instantly. Analyst models, though, they tend to be sticky. They're often based on assumptions that just got invalidated by that Q2 report. So downward revisions from these analysts seem highly likely. I'd caution you, the listener, against relying too heavily on these current targets. They feel outdated already. The general media tone, as you'd expect after that earnings report, has been overwhelmingly negative. Headlines like, why Redwire stock imploded today really signal the investor concern, and key market indicators back this up. Short interest is exceptionally high, 15.42% of the public float.
15% short interest. That's significant.
Very significant. It signals deep skepticism from a segment of the market. It's a powerful bearish indicator. The stock's price is also trading way below its key moving averages. It's 41.62% below the 50-day and 32.51% below the 200-day. That indicates a severe technical breakdown, a real break in the stock's longer-term trend.
Okay, with all this deep market pessimism swirling around, let's explore Chapter 5, ownership structure. Who actually owns the biggest pieces of Redwire, and what does that mean for its future direction?
This is really interesting. Redwire has what I'd call a highly unconventional ownership structure for a public company. The shares are heavily concentrated among private equity and strategic holders, not widely distributed like, say, Apple or Microsoft. The largest shareholders are Edge Autonomy Ultimate Holdings. That's from the acquisition. They hold 34.9%. And AE Industrial Partners, the private equity firm that created Redwire, holds 25.1%. Together, they control roughly 60% of the company.
60% controlled by just two entities.
Exactly. Contrast that with traditional big institutional asset managers. BlackRock owns about 1.24%, Vanguard about 1.04%. Tiny stakes in comparison. Insider holdings management and board also relatively small, around 1.5%. Now, we did see some positive signals like the CEO, CFO, and a director making open market purchases back in March 2025. That can be seen as a vote of confidence, putting their own money in. However, there were also some non-open market dispositions, maybe related to compensation or agreements in July 2025, and there were significant insider sales back in July 2024. So a mixed picture on insider activity. But the key takeaway here, the key implication for you as an investor, is that Redwire functions much more like a portfolio company of AE Industrial Partners that just happens to be publicly traded. Private equity firms, they operate on a specific playbook, right? Often focused on optimizing for an eventual exit, selling their stake down the road. Take that massive Edge Autonomy acquisition, a $925 million deal. It was mostly paid for using Redwire's public stock as currency. This led to absolutely massive shareholder dilution. A staggering 117.4% increase in the number of shares outstanding over the past year.
So existing shareholders got significantly diluted.
Hugely diluted. It means major strategic decisions might be optimized not necessarily for all shareholders, but potentially for the private equity sponsor's exit value. This could introduce significant risk and further dilution for public shareholders. Essentially, if you're investing in Redwire today, you're kind of becoming a minority partner in AE Industrial Partners' long-term strategy. That's important context.
That's a really crucial insight into who's really pulling the strings. Okay, now for Chapter 6, risk assessment. Every deep dive needs a good, hard look under the hood for potential pitfalls, but also opportunities. What are Redwire's key strengths, weaknesses, opportunities, and threats? The SWOT analysis.
Okay, let's break down the SWOT. On the strength side, you've got that extensive flight heritage we talked about. Super valuable. They have a valuable intellectual property portfolio. They're embedded in key government programs, which provide some stability. And they do have a diversified product portfolio. But the weaknesses are pretty glaring right now. Chronic unprofitability is number one. Consistently negative cash flow. Poor execution on contracts, clearly highlighted by that big Q2 EAC adjustment, and, as we just discussed, high shareholder dilution. Now for opportunities. There's definitely the massive growth potential of the overall space economy. That $1.8 trillion projection by 2035 is a huge tailwind. There's the expansion into the defense market through the Edge Autonomy acquisition. The ongoing commercialization of low Earth orbit presents opportunities, and potentially novel markets like their SpaceMD pharmaceutical venture. But they also face clear threats. Intense competition from both giants and specialists, a heavy dependence on often unpredictable government budgets, potential supply chain vulnerabilities which affect everyone these days. And of course, in tech, there's always the risk of technological obsolescence.
And beyond their specific business dynamics, how do broader factors like the economy or geopolitics play into their risk profile?
Yeah, macroeconomic factors are definitely relevant. Inflation is a direct threat to Redwire's profitability. It increases their costs, especially hitting those problematic fixed-price contracts that already have those razor-thin margins. Higher interest rates make everything more expensive. It increases the cost of servicing their existing debt, makes it harder and pricier to raise new capital if they need it. And technically, it also leads to a higher discount rate, the WACC, used in valuation, which fundamentally lowers the calculated intrinsic value of the company. Geopolitically, something specific to mention is the U.S. imposed tariffs in 2025. These could potentially increase costs across the entire space sector's value chain. For Redwire, this could directly inflate their cost of revenue, further squeezing those already precarious gross margins.
All right, we have journeyed through the nooks and crannies of Redwire. Now let's bring it all together in Chapter 7. Conclusion. How do we synthesize all this complex information?
Redwire is really at a critical inflection point. That's the main takeaway. You have this compelling long-term vision, this idea of a pure-play investment tapping into that tripling space economy. They've made a potentially transformative acquisition with edge autonomy. They possess a strong technical moat with their heritage and IP. If, and it's a big if, a turnaround actually occurs, it could be deeply undervalued right now, especially considering those optimistic analyst targets suggesting 100% plus upside. That's the essence of the bull case. However, that vision is just clashing violently with a pretty disastrous near-term reality. The bear case points squarely to the ongoing operational crisis, epitomized by that huge Q2 EAC miss. It points to the deep financial distress, chronic unprofitability, accelerating cash burn, the debt concerns. It highlights that shareholder-unfriendly structure with the private equity control and the massive dilutive equity raises. And it underscores an extreme overall risk profile, reflected in that high volatility, the clear execution risk, and that very high short interest betting against the stock.
Yeah.
So our educational DCF model, acknowledging all its uncertainty, places Redwire's estimated intrinsic value in that very wide range, $7.50 to $14 per share. And the current share price around $9.40 that falls right within that broad uncertain range. It really underscores just how speculative this investment is at this moment.
So, wrapping this all up, what's the bottom line? What should you, the listener, really take away from this deep dive?
I think the clearest way to put it is that Redwire Corporation represents a classic high-risk, high-reward scenario. It truly feels like a binary path forward. Path 1, a successful turnaround. That means effectively integrating edge autonomy, imposing some serious operational discipline they haven't shown consistently, and finally achieving sustainable, profitable growth. If they manage that, it could unlock significant value from these levels. Path 2. Continued execution failures, ongoing cash burn, and a failure to address those deep underlying operational issues. That would very much validate the bearish case, and the stock could have further downside. The current valuation clearly reflects deep market pessimism, so whether this ultimately proves to be a generational value opportunity or just a classic value trap, it will depend entirely on the ability of this management team to restore credibility and, really for the first time in its history as a public company, deliver consistent, profitable growth.
So as you think more about Redwire, maybe consider this provocative thought. How much weight do you, as an investor, personally place on a compelling long-term vision and those strong macro trend tailwinds, especially when you're faced with really significant and consistent near-term operational struggles and clear financial distress? How do you balance the undeniable promise of a rapidly growing industry like space against the demonstrated execution risk of one particular company within it? Food for thought. If you found this deep dive valuable, we'd really appreciate it if you'd like and subscribe to the stockanalytics.ai YouTube channel. Members get priority deep dives on tickers. It's €4.99 a month. And over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those. If you just want a one-off deep dive on a specific company, you can always drop us a super thanks on the video. And please remember, we will be covering earnings for Redwire within minutes of release, so make sure you stay tuned for that update.
And just the standard reminder. This analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.